This is where we'll start. Josh Brown, is this the beginning of a big tech bounce back?
I mean, today is a big tech bounce back. It doesn't need to be the beginning. ARK is up 9%. The MTUM Momentum ETF is up 4 or 5%. So it's happening right now. The question is it sustainable? And do most of these stocks get back to their previous highs? I would say probably most don't, but some will. And so this becomes the type of market where you say to yourself, if I miss the Shopifys and the Squares of the world, and I've been watching them for the last year and saying, I can't believe I didn't get in on that. Well, the majority of these names are down between 25 and 50%. So this is where you would buy those and add them to your portfolio. If you had too much of that stuff, if you were loaded to the gills with the Teledocs and the DocuSigns and Twilio and Zillow and on, this bounce gives you the chance to lighten up. So I would say that it's a Rorschach test. What did you hate the most about your portfolio before this huge moment where value went crazy to the upside and tech got killed? How do you want to address it today? So from my perspective, there are some names I like a lot for the ultra long term. PayPal's on that list. Zoom is on that list. These are stocks that I have a very low cost average. So if I were to buy them right now, I would be averaging up. But I may do that because they're names that I think I'm getting at a big discount relative to where they could be in the future.
Okay.
But that doesn't apply universally across the board.
No, I hear you. Look, there are a lot of other stocks that are down a lot, and you obviously are not looking to pick those up on whatever discount some people may think exists. Surratt, however, you must think we're at the end of the tech route because you're buying Facebook and you're buying some chip stocks, too. You've got Qualcomm and NVIDIA that you've been adding to. So tell me how that factors into your perspective on where we are.
So I think to Josh's point, I'm looking for long-term holdings that have come down quite a bit. Core holdings that I have, and I've got new money added. I want to own NVIDIA. I want to own Qualcomm. I agree with Josh on PayPal. I think these are the long-term secular growth players that I think as we get through this cycle of interest rates going up and value performing, these are stocks that are fundamentally going to grow, have great cash flow, and have, for NVIDIA, for Qualcomm, you get 5G in front of it. I've even added to American Tower. That's a tower company that's down almost 10% this year. So I like that. I mean, I'm barbelled because I'm overweight financials. I've got almost 17% of my portfolio in financials. So this is a way for me to add growth into an area that I've been a little bit underweight, or for clients that have added new capital.
Let's talk about, Steph, what we think is potentially on sale, oversold, maybe going to ride a wave of a tech bounce back if you do believe that we're going to get that. Josh alluded to the big stocks that are down a lot, okay? And everybody owns pieces of these. Apple's down 17% from its high. Amazon's down 14% from its high. Facebook's down 13%. Netflix is down 14%. Is it time to buy these stocks, Steph, like Surratt has? Are we at the end of this route?
Well, I have been focusing on semiconductor, semi-cap equipment names because I like the end markets. You do get data center, cloud, AI, 5G, all of that. You get auto, you get industrial, and the valuations are very reasonable. And I don't think they're nearly as crowded as the FANG stock. So FANG, to me, I'm underweight FANG, but I am way overweight on Alphabet. That's the one name I'm placing my bet on. It's only down 5% from its high, but I think the operating leverage story for 2021 is really very exciting for them. But the other names, we talked about Broadcom and how I added to that on Friday after the quarter, beat and raised, and the stock fell. And I love that combination because I think it's just a short-term reaction. But I really still do very much like NXPI. It's down 14% from its high. It's a very wild, crazy trading name. But it is auto, which is 40% of their business. They have 11% market share. And contactless payments, we all know about that. So I think that's 14% of their business. So I actually like that name a lot. They just increased the dividend by 50%, a new $2 billion buyback. I also like Lam Research on memory spend and recovery. DRAM is very strong, but NAND is not. And that's a second half of the year story. And then lastly, Fortinet, cybersecurity. So I can find places in tech, Scott, but I think you have to ask the question, why did tech sell off in the first place? And it's a function of higher interest rates, better economic growth, inflation break-evens going higher, and mean reversion. It was the XLK was up 94% from the March lows. So a little mean reversion, fine. So you pick and choose the ones you want, where you want to be. I still do believe very, very strongly that in a year's time we are going to have higher interest rates because we're going to have faster growth and a little bit more inflation. And I think you want to have, we've talked barbell, I have less of a barbell these days with 70% cyclicals, 30% defensive quality tech, but I still think you want to have that as your strategy into this year.